Hello, my name is Ijahnay Black, and I'm a senior accounting student in the University of South Florida's Honors College. Here to talk to you today about the equity of our U.S. tax system, both why income inequality exists, as well as how we as a nation plan to fix it. A key component of being a productive citizen is the duty to contribute to the funding of state and federal governments by paying taxes. It is one of the few inevitable civic responsibilities that all working members of society must face, and that is punishable by law if it is neglected. Conflict arises when income inequality becomes a factor and the fairness of the current American tax system is criticized. Income inequality is a worldwide issue, and the gap between the rich and the poor has gradually gotten wider. Currently, the world's richest 62 people have as much money as the poorest half of the world's population, approximately 3.2 billion people. The nation's most wealthy citizens, otherwise known as the 1%, contribute the majority of income tax proceeds that are generated by the U.S. government. Still, there are grievances among the average American taxpayers that high-income earners, as well as corporations, should pay their fair share. There is a consensus among the American public that tax policies tend to favor high-income earners and corporations. But is this a fair assumption? Let's begin by examining income inequality and what causes it. The extent to which income and resources are unequally distributed within a population is known as income inequality. By all measures of wealth, income inequality has been increasing in the United States since the middle of the 1970s. What are some causes of this? Well, it is believed that perhaps the rise of inequality is coincided with the expansion and advancement of globalization. Globalization provides more channels through which income can be earned and alters tax implications of foreign earned income. Another possibility for the cause of income inequality is skill-biased technical changes. The job market is much more competitive and skill-intensive today than it was just 3 decades ago, and each career field tends to favor top performers in their respective field. These top performers are often those who can afford to pursue higher education and advance in their careers. A third explanation is compensation practices for executives. A significant portion of salary for executives is paid in the form of stock options. Earning a salary in this manner allows for considerable deferral of income and is subject to preferential capital gains rates when taxed. This compensation practice also causes an inevitable link between stock market price and the income of executives. Societal norms may also play a role in growing income inequality. In the past, there was an inherent opposition to high salaries that has diminished over time. This reflects a shift in what Americans believe is fair compensation for executives, celebrities, athletes, and other high-income earners. So what are some ways we work towards closing the gap between the rich and the poor? Well, a large impact on mitigating income inequality is made through the use of various policies, including those regarding taxes and redistributive efforts. Public policy forms the distribution of income, and state tax laws have played a considerable role in the reduction of income disparities since the early 1980s. There are 4 common approaches that states use to combat income inequality: taxes on the wealthy, taxes on the poor, spending on the poor, and labor market policies. When it comes to redistribution, transfer systems such as welfare, temporary assistance for needy families, and Medicaid are the most direct type. However, redistribution can also be implemented through a tax system. For example, the Earned Income Tax Credit, which is a fully refundable tax credit that is available to low-income households who meet certain requirements. Now, let's shift our focus to the group of individuals on top of the income hierarchy and whom economic policies affect the most, the 1%. In the United States, the top 1% of earners have an annual income of around $400,000 or more and own approximately 40% of the nation's wealth. There is a distinct correlation between tax policy and high-income earners. By observing the behavior of these taxpayers in direct response to legislation, it is evident that policy influences their financial decision-making. Although it is a common public sentiment to want to force the 1% to pay their fair share in taxes, increasing tax rates to target high taxpayers causes these taxpayers to no longer be incentivized to earn and realize income. As taxes increase, top percentile taxpayers will attempt to reduce their taxable income by earning less or shifting their income to individuals who are subject to lower tax rates. In 2006, the top 1% of American taxpayers, ranked by income, paid 40% of federal personal income taxes. Because of their significant contribution to governmental revenue, any decrease in the recognition of the 1%'s income makes a drastic impact. So if raising rates is not the answer, what are we doing to change the tax system? Most Americans agree that the tax system needs to be fixed, but what exactly is wrong with the tax system? According to CPA David Lifeson, there are four main issues: complexity in the integration of regular income tax, alternative minimum tax, net investment income tax, Social Security tax, and Medicare tax; misaligned incentives in the international tax structure affecting border adjustability and global tax competition; estate and gift tax regimes; complex tax incentives directing or misdirecting economic behavior and favoring some businesses and activities over others. With all of these problems, what solutions have been proposed to address them? On September 27, 2017, the Trump administration debuted a highly anticipated tax plan titled Unified Framework for Our Broken Tax Code, composed by the Big Six. The four principles set by President Donald Trump that the plan claims to be based on are as follows. 1. A simple, fair, and easy to understand tax code. 2. Allowing workers to keep more of their income. 3. Attracting jobs by leveling the playing field for U.S. businesses. And finally, to bring foreign-held money back to the U.S. to reinvest. The most notable changes that the plan proposes are nearly doubling the standard deduction, reducing the number of tax brackets from 7 to just 3, repealing the alternative minimum tax for both individuals and corporations, and decreasing the corporate tax rate from 35% to 20%. The framework seems to follow the more indirect trickle-down method to benefit middle-class working taxpayers. In other words, by cutting taxes for corporations, they will pass the savings on by way of better productivity, new jobs, etc. Thanks for watching.